Evening, everyone. Thanks for joining us. We're here this evening to talk about the wonderful, exciting land of pensions and taxation. You know, you don't normally hear those two words in that sentence of pension and taxation as being exciting, but it may not be overly exciting, but it is very, very important. Guys, my name is Pascal Kern, and you're all very welcome to our webinar this evening. I am delighted to be joined by an accountant friend of mine who we have teamed up on a few cases now, and it's always very good to get an accountant's view when it comes to taxation. So Jennifer is also going to do part of the presentation with me, and you'll meet her later on. So today, guys, we're really talking about pensions and the pending tax deadline that's coming down the line very shortly. And so just to introduce you a little bit of who we are, for those that don't know who I am, my name is Pascal Kern, and I own a company called Advice First Financial. I've been providing advice to customers in Donegal and actually throughout Ireland since 1992. I became a very bad employee in 2004, and I decided that the only person that could really employ me was me. So Advice First was started in 2005, guys, and I say I've been providing pension advice along with life cover and mortgage advice since 1992. So we are regulated and registered with all the bodies that you would expect, the Central Bank of Ireland, Brokers Ireland, and all the rest. So we are trusted advisors, guys. So if you need any advice or questions after this, by all means, come back to us. So today, Jennifer's joining us as well. So Jennifer's a chartered accountant. So she's going to take us through pensions and the tax deadline from an accountancy point of view. So again, if you have any questions from an accountant, now's the time, guys, when you get access to one. Okay, so why are we here? We're here to talk about pensions and deadlines. So I thought I would start with a very basic question. Like, what is a pension? And no matter what way we cut it or what way we call it, a pension is just a tax-effective way and a tax-efficient way to save for the lifestyle that you need in later life. Now, there is a term being bandied around now around pensions and when you retire, but your second life or your second wind. And a pension is really what you use to leverage during your working life to save and squirrel away money that you're going to use when you're no longer working. And guys, no matter whether you're an employee, a company director, self-employed, that's all a pension is. They are complicated and there's a lot of noise and there's a lot of different kinds, but that's really what it is. So who can make a pension contribution at this time of the year and claim back tax for 2023? Pretty much anybody, actually. Self-employed people, employees, whether you're in an employer scheme or not, you can make pension contributions at this time of year and claim tax relief back for 2023. And we're going to see a couple of examples of this as we go through. If you're a director in the company, again, your company tax year may not be this time of the year, but it doesn't stop you making pension contributions. Public servants as well, guys. Very, very important for public services to use the AVC facilities. So I'm going to take you through a little bit of a couple of examples around how that actually works as well. So why should you save for retirement? And I get this question, or rather this statement, pushed at me nearly every day is, why would I bother? And guys, the only answer I've really got is, do you want to live on 277 euros a week? Because that's where it is. If you're retiring today, that's what you're getting. Now, it is going up, obviously, in the budget. It went up by 12 euros a week, but most of us are going to be working for 20, 30, 40 years. And if you're going to work that length of time and depend on the state to keep you in retirement, it's not a great outlook. And what I find when people retire, and we have a lot of people already that have retired, and when I speak to them, there's two types. There is the ones that are existing and the ones that are living. And if you have your health, unfortunately, the ones that are living and the ones that are existing, the only difference really there is money. The ones that are living have got a few quid. The ones that are existing are living from week to week. That's the only difference, guys. So don't depend on the state pension. The state pension is helpful, but it may not and probably will not be enough to keep you. So you've got to do something about it. And the best way to do that is through pension. Tax relief. So what sort of taxes and how are pensions treated? And you probably already know a lot of this stuff, but it's no harm just to cover the basics before we get into the meat and the bones of this. So for every pension contribution you put in, you can claim back 20% or 40% depending on your level of income. There is tax-free growth on your investment. So any money that you put into a pension scheme, regardless of what type of pension scheme, there is tax-free growth on the investment. There is no other investment that has tax-free growth. None. So you can imagine how tax-free growth and compound interest works, because any money that goes in there is compounded. So you have tax-free growth and compound, and over the years, guys, that makes a huge difference. The other tax benefit is when you come to pension age and you actually want to draw your pension, depending on the type of scheme that you've got, 25% of the fund can be paid tax-free. If you're in an employer scheme like the public service civil servants, or if your employer is paying into a scheme, there is also a tax calculation around service and salary that can be used. And it really depends on which one of those best options that you can use. But in terms of taxes, guys, those are the benefits of actually making pension contributions. Revenue give generous tax relief on pension contributions, allowing you to reduce your tax bills, especially at this time of the year. And again, I'm going to show an example of one that we're actually working on for a client at the minute, and you'll see it later on and how effective it actually is. What's the maximum pension contributions that you can make? And this is based greatly on your age. So let's say somebody between age 30 and 39 can actually pay 20% of their net relevant earnings in and write the whole thing off against tax. If you're 60 years of age, you can actually invest 40% of your income and get full tax relief at 20 or 40%. Now, we are limited to the upper income level at the minute for 2023 is 115,000 euros. So if you're earning more than that, we can only count up to 115,000, and we use the rate band then based on that. And obviously, as you're getting older, the contributions that you can put into your pension increases, and this is to help you actually catch up. Because if you're 25 and putting in a pension contribution, it obviously is going to be different than the person putting in at 55. So you're allowed to fund a lot heavier as you get older. Employer contributions. This is quite an interesting one currently. Now, there is a lot of change. There's a lot of change coming in this one, and I would say it's coming quite quickly. Employer contributions to PRSAs, there is no limit at the minute. Now, let me put that in context. If you are a director of a limited company and your company has a load of money sitting in it, you can literally put it into your pension account and write it off against tax. There is no limit. So whether you're a director of a company or an employee of a company, if you've got great employees and you want to give them a reward, it's actually more beneficial to put it into a pension arrangement than it is to give them a pay rise. Pay rise, they pay 40% tax. Throw it into a pension scheme for them, they'll pay no tax, and neither will you. So at the minute, there's great scope on the PRSAs. That is changing because a lot of people took a lot of advantages on it. You have people earning 15 grand a year and suddenly throwing 500,000 into a pension fund. So revenue are not comfortable with that sort of a thing, and they are looking at it. But at the minute, guys, there is a great opportunity there for anybody that wants to dig into it. So what are the options? What does the pension land look like? And it is different types of pension arrangements for different types of employment categories. But for self-employed and employees, where they're not in a company scheme, there are a couple of options. PRSAs came in around 2002. They are probably the most popular option now, and they're popular because they're very, very portable and flexible. You can stop and you can start and you can move it and you can take it with you when you leave your employment. They are a very, very flexible tool. The older personal pensions are still there, and in some cases we use them because they actually fit for some higher earners. They fit them better. Self-directed pensions is one that a lot of, say, self-employed people and company directors are actually looking at the minute because it allows you to have more control over where you invest money. Now, you need to have an existing pension pot to get access to this one, but we would have a lot of people buying property with a self-directed pension, whether it's commercial property or even in some cases residential property. We have one at the minute where we have gone in through a mixed-use development and they're buying it through their pension fund. So that's a self-directed pension. Is there very popular, but guys, take advice. The most popular option in Ireland is PRSAs. At the minute for self-employed, while you're building and trying to accumulate a pension fund, at the minute a PRSA is the most used product. When you have the fund already, a lot of, depending on the size of the fund, depending on what you want to do, Some of them are moving into a self-directed option that gives you more choice and more control. Pension options for the public sector and employer schemes. So if your employer is paying into your pension scheme, then you have a PRSA AVC. If you're a member of the public service, nurses, doctors, teachers, you have an AVC option. You also have a buyback years option. Now, this is for the public sector only. When we look at the public sector buyback, it works out very, very expensive to buy back the years. So I would always encourage you to look at both, but look at the buyback years, but also look at the AVC option, because the AVC can actually be a cheaper model. One thing I will say, guys, is, and I know for especially the public sector, the likes of Corn Market and Irish Pension and Finance, they kind of have you all corralled into the group schemes because it's in through the unions and all that. My advice is always look at the private AVC. I'm not saying don't do the group scheme, but look at the private AVCs as well. Two things happen is, one, the group schemes are very restricted. And generally, and it's a very general statement, generally you've got a choice depending on who you're dealing with, whether it's Irish Life or New Ireland. There are other options. You just don't get access to them. There are other charging structures. You just don't get access to them. And sometimes in the group schemes, the charging structures are hidden within the costs of the plan and can be expensive. So guys, don't just take it at face value. Shop around. Why do a pension at all? If you get to pension age and you cannot live in the state pension, you're going to be cannibalizing your assets. You're going to be dipping into your savings and you will burn through them. And that's the problem. Pensions is a tax-effective way to save for retirement. And it just ensures your financial security when you get there. Because you don't want to get to 65 to have to live in the state. Doing something about it over your working life is the answer. That is the best way to do it. And pensions can form part of it. It doesn't necessarily mean to have to be all of it, but it should form part of it. Relying solely on the state pension or the employer scheme can be risky, depending on what's going to come out of it. So the first thing is get to know what's going to come out of it and then see, does it fit what you're trying to do? Pensions and tax deadlines. So this is really where the crux of it. And again, Jennifer is going to take you through parts of this as well. So what we're doing at the minute is we're talking to a lot of our existing clients about making contributions now that we can write off against tax in 2023. And the important dates here is the 31st of October. If you are paper-based and doing a paper-based return, you've got to get this done by the 31st of October. If you're online and working with an accountant like Jennifer or your own accountant, the 14th of November. Now, I would say the 13th of November actually to get it in, because it has to be in by the 14th, by the close of business. And two things have to happen and must happen. Your contributions have to be paid to the company and the proof must be uploaded to revenue by the 14th. So don't wait till the 13th, guys. Get it in before that. In fact, you should get it in as quick as you can and move on as quick as you can, because there are lots and lots of it going to happen. Let's not get caught being late. Accessing your pension. And again, guys, why do you put money into your pension? And again, we're working to a point where I'm going to show you a couple of examples of what's going on with this. But how do you actually access your pension? And this is a lot of the time where I like to take people to first, because everybody tells you that having a pension in place is a great idea, but only if you, one, understand how you're going to get access to the dough at the end of it, and that you believe in it, that it is actually going to give you what you want. And remember, what a pension actually does, it provides an income for you when you want to stop work. When you want to stop work. Some people will work on till they have to stop. But if you get to a point in your life where you want to, then a pension will help and replace that income. But the first thing that happens, and the first thing we advise people to do, is work out how much of your pension fund you can get back tax-free. And always take the tax-free amount, as much of it tax-free as you possibly can. Depending on the type of scheme that you've got, for the likes of the self-employed employees that are not in company pension schemes, you'll get 25% of whatever you've saved. You can get up to 200 grand tax-free in that. So if you had a fund, big number, 800 grand, 25% of that's 200,000, you'll get it tax-free. If you're in an employer scheme like the public sector or if you're an employer, if you're some of the employers that pay a pension for you, there is also a salary and service calculation for the tax-free amount that can be used. Either way, you're entitled to a tax-free amount. After that, the remaining 75, if we call it 75%, obviously, if you're using a salary and service, the figures mightn't be 75, it could be 50% left over. There are a couple of options. You can buy an annuity, which is a guarantee of life, a guaranteed income for life. Now, it's very, very important to understand what this actually means. So if we go back to the example of saying you have 800 grand and you get 200,000 of it tax-free, obviously that leaves a fund of 600,000 euros. If you buy an annuity, you give away the 600 grand. It's gone. You never will get it back again. But what you get in return is a guarantee of income for the rest of your life. Whether that is a fortnight or you live to your 172, a guarantee of income. And shop around the annuity. If annuity is what you want, do not take it with the company you're with before you shop around. And you can shop around the money. The other alternative option, and for the most part, this is the option that's probably more used now, is an approved retirement fund, an ARF, as the industry speak for it. And the reason it's more used at the minute is the flexibility around what you can do, because you keep control of the money and you draw the money as you want, not as a guaranteed income. You can draw out 40 grand this year, you can draw 50 grand the next year, you can draw nothing the year after that. And the important thing with an approved retirement fund is if you pass away, it goes to your estate. Where if you have an annuity, it does not. So there is a lot of control differences there, and it is hugely important, guys, to seek advice when you're planning for your retirement, what options you should plan for. Remember, though, that the income that you get, whether actually it's a guaranteed annuity or whether it's an income from an approved retirement fund, it is a taxable income. That's why I said at the very start of that slide, take as much as you can tax-free. Hugely important. How much should you contribute to your pension? As much as possible. So aim to take up the max. Guys, there is tax-free. If you're paying 40% tax and you put 1,000 euros into your pension, it's costing you 600. So there is nothing, absolutely no investment that you will get at a return like that. And if you turn that around and said, well, listen, if you started with 600 euros and you wanted to get it back up to 1,000 euros, you would have to get a return of 66% on 600 to get it back up to 1,000 euros. So essentially by putting 1,000 euros into your pension, you're getting 66% growth. Nothing to touch it. And that's before you even talk about investment performance, which company, who is the best fund performer. It doesn't matter. Straight away, good idea, 66% on your money. There's nothing to touch it. And the earlier you start, the better, obviously. So the more money that you have in your kitty, the better retirement planning you're going to have. Factor in when you want to retire. What lifestyle do you want? And do you have anything else? And what I mean by anything else, retirement planning isn't all about pension. You may have property. You may have paintings. You may have jewelry. Like I have some guys that are investing in whiskey. Whatever the plan is, make pension part of it, but have a plan and work through it. Consider how much income you want every year is a huge one. Because some people want, 30 grand a year and I'm happy. Other people want 100 grand a year. Your plan is different. There isn't a one fits all. Seek advice, guys. Sit down and talk to a good financial advisor. If you're stuck, I know one, but biased, but I do. Starting early is key, guys. The longer you have your pension pot in place, the better. And what we're really talking about here is the factor of compound interest. So you can imagine if you started a pension at age 30, compounded interest, even if you're only getting a small bit of growth, one, it's growing tax-free, so there's no taxes on it, and it's compounded every year. Death and taxes and compound interest are the three wonders of the world, guys. Okay, a couple of examples. And guys, if you want to ask a question, and I see if some questions popping up and we will get to them, there are a couple of ways to do that. There is a chat facility there. By all means, pop your questions in. We're going to leave time at the end of the presentation for answering your questions. And by all means, I'm not in any hurry this evening, so if you have loads of questions, there's not a problem. I wanted to walk through a couple of examples that we're working on. One of them we did last year. The other two we're actually working on at the minute. So we're looking at a pension scheme for a guy. Now, this happens to be in the public sector, an employee, based on 30 years service, is working towards retirement. And what we've done is, the guy's on 60K a year. We know because of his 25 years service, actually, that's a mistake. Sorry, should be based on 25 years, not 30. So excuse me on that one. Based on 25 years service, we know that he's going to get 84,000 euros tax-free, because that's going to be paid from the superannuation scheme. We also know because of his salary that revenue will allow him to get 135 grand tax-free. So what do we do? Just show how we work that out, guys. Our advice, save the difference. So the difference between the 84,375 and the 135 is 50,625. He can put that money in and get 40% tax relief on it. So he saves 20 grand straight away. And we give it back to him tax-free. He gets 135 grand tax-free instead of 84. So he puts the dough in, 40% relief, and we hand it back to him tax-free. That's one we did last year. Another example, pension contribution 2023. You have a 60-year-old, income 70K, he has no pension in place. Nothing. So again, what he can actually put into his pension is 28 grand annually. So he has a choice. He can put a 28 grand in for 2023, and we'll give him tax relief at 40%, so he'll get 11,200 euros back in tax relief. And that's for 2023. If he commits to doing it again for the year of 2024, he also can get 40% tax relief on his preliminary tax for 2024. So there's another 11,200 euros of tax relief straight away. The actual cost to him of investing 28,000 euros in a pension pot actually is costing him 5,600 quid. Nothing to touch it, guys. There is no investment. Nothing. Nowhere to do this. And the way we're setting this one up for this particular guy is he's putting in 20 grand for 2023. We're also setting up a monthly contribution to actually fund the 2024 number. So guys, there is nothing to touch this. Another example, pension contribution, public servant, age 45, salary 70K, obviously paying into the superannuation scheme, because public servants, as you probably are aware, if you're a public servant, you don't have a choice. You have to pay into the ABC. So the maximum contribution that you guys can make if you're age 45 is 25% of salary, which is 17,500 euros. Your payroll deduction, depending on where you are within the public servant, somewhere about 6 or 8% of your salary. That's what comes out of your payroll deduction. The balance you can put into an AVC. So you can invest 17,500 into your pension and get full tax relief on it. And again, I don't advise you doing it through the group scheme. I advise you taking a look first before you do that. Take a look at the private AVC sector and see who is doing what and what the charge and structures are. You will find that there's better options. So, guys, I just wanted to touch on a couple of other tax effective protections that are in place. Some of them you'll know, some of them you may not. Obviously, the number one, when it comes to tax efficiency, we always talk about pensions, 100%. The first protection that you should have is your income in terms of when you retire. To protect that first. The second one is actually salary protection as you are going through your working life. Because all your plans will go out the door if you're not able to work and earn your money. The first thing you will stop is your pension contribution, because your lecky bill has to be paid, your mortgage has to be paid, the car loan has to be paid, the kids have to go to college. Everything will stop. So your plans for retirement will go out the door as soon as you stop getting your income. So protect your income on the way through, guys. And again, you get tax relief on that as well. So if you're investing in an income protection plan, there's 40% tax relief if you're on a 40% band. There is also a little product that not a lot of people use and is very, very effective, is pension term life cover. You can actually get tax relief on your life insurance, even though most people tell you won't. You can. But now it doesn't suit everybody. So there is a way we use that. Happy to explain it and happy to go through it. But it's not for everybody, but it is there. And again, you can get tax relief on that. And Jennifer's the one that'll be more attuned to getting tax relief. But in terms of we use these three options quite a lot, and you can claim tax relief on all three as long as they are structured correctly. What is income protection? Provides a regular income, guys. And again, I'm just kind of going to run through this. Big important one, self-employed people, you're not entitled to any sick pay. None. Company directors, if you own more than 25% of the company, you're a proprietary director, you're not entitled to sick pay either. So if you go out sick, you are on your own. Protect your income, guys. Huge one. If you're an employee, then the income protection just boosts what you're entitled to. You're entitled to £237.50. It's going up by 12 quid a week. You're entitled to 250 quid a week. If you're already earning 700 quid a week, you can imagine the lifestyle shock that you're going to have if you're on 237, guys. Protect your income. It's essential for your financial stability, guys. It just makes sure that you continue to do what you do. All your dreams, all your aspirations go out the door once something happens. A little bit of an investment can help along the way. Benefits of income protection, peace of mind, obviously. You know your income is going to get paid. Flexible cover, it can be tailored. Whether you've got a company scheme or not, some company schemes, the likes of public sectors, you have 3 months full pay, 3 months half pay, but then you're on your own. So again, for you, you can have an income protection kicking in after 6 months. The big one is, guys, that you get tax relief at a marginal rate of 40 or 20%, depending on what tax you're paying. So again, use these tax break, guys. The revenue are going to help you save and for the investment it takes to actually protect your income. Use it. Key takeaways, pension planning. We must be proactive in retiring. If we're not, we're going to live in the state pension, guys, and it's not a great place to be. Nobody wants to do this. Protect your income. It's a given. Everybody should have protection on their income. Take advantage of the tax release, because once you're gone, they're gone. You can't suddenly run back in 4 years' time and say, oh, goodness gracious, I didn't do that. But take it as you go. The state pension alone is unlikely to keep us. Guys, the way they're talking about the aging population in Ireland, I'm not even so sure there's going to be a state pension in the way we know it. And they're already changing in how they're going to establish whether you qualify for full state pension or not. They're actually looking at now as an average how many stamps that you put on over your working life. So when did you put on the first one and how did you do every year since? That's the way they're going over the next few years for your state pension. Start early, guys, and be conscious of what you're doing. And seek a trusted financial advisor. Again, if you're stuck, I'm a little bit biased, but I'm here to answer any questions, guys. Next steps, assess where you are. The first thing you've got to do is take a stock take. Where am I with my financial goals? What would I like to happen? What needs to happen? And put in place the protections. Everything that you want to do, guys, is around protecting your income. And maximize any tax breaks, any tax reliefs. 100% maximum. We all need to be proactive in our pension planning and our income protections, guys. We've got to make sure that we get to a certain age and have a decent standard of living when we get there. My name is Pascal Kern, guys, from Advice First Financial. If you have any questions or queries or concerns, my email address is there. I'm not hard to find. By all means, give me a shout. Jennifer, you're going to take us through on the tax side of it. Let me just give you control, and hopefully you will be able to work away. And guys, we are saving a bit of time later on as well for questions and answers. Jennifer, have you got control?
I think I do, yes.
Good on you.
Well, thank you very much. That was very, very useful. It's very important to know all that information. So, hi everybody. My name is Jennifer Harrison. I'm a chartered accountant here in Letterkenny. I have been in practice myself for about 19 years, and I set up my own just over 4 years ago, working through sole trader company set of accounts just to help people along the way. So today I just wanted to touch base on a few things that's important for the taxation, and just to add on to what Pascal was talking about pensions as well and the benefits that are available. So I know Pascal's already noted the revenue deadlines and payments. I wanted to talk about taxable income. What income is taxable? And there's some that are exempt, and who has to return it. Looking at your tax rates, bans and reliefs, these are available to everybody. They are based on your personal circumstances, and the tax credits are the same. Going to look high level at an income tax return from a sole trader point of view. If you are a PAYE worker, you won't have the same return, but you will have a very similar one. It's just on a different format or a different platform. I'm just looking at the pension section within the income tax return, just to show you where it needs to go. So, as Pascal has noted earlier on, the income tax deadline now for online submission is the 31st of October, 31st of October for paper form. I think nearly everybody does the return now online, so you do have the extension to the 14th of November. And that is to file and pay your 23 return and pay your prelim tax for 24. If you don't meet that deadline, even by 5 minutes after the deadline on the 14th of November, you will be charged a 5% surcharge on the liability. So that's your tax bill. So you have 5% additional surcharge on your liability. If you have no liability, obviously there'll be no surcharge. If your return is late by more than 6 months, there will be a 10% surcharge. In addition to that, Revenue have introduced a surcharge if you don't file your local property tax. So everybody has to pay their local property tax every year. Every couple of years, there's an annual return that you need to do just to show the value of the property. That needs to be returned. If you have not kept that up to date, you will have a surcharge on your tax return. If that is the case, just come back out of the tax return, fix or amend the issue, and then go back into your return and the surcharge will disappear. If you're late with payments, Revenue does charge you an interest rate. The interest is dependent on what type of tax it is. So IT, which is income tax, CT, corporation tax, and CGT is capital gains tax. And that is 0.0219%, and that's per day or part of that day. So that can be quite significant. There's a slightly different rate for the other taxes, such as PAYE, PRSI, local property tax, VAT, and RCT. But the main one for yourselves will be the income tax here. Just wanted to note, just to let people know that you're taxable in near enough everything that you earn. So if you have any income, I've noted a few down here on the screen, but this is just a few. So any income that you receive from your employment, self-employed, rental, investment, pension income later on, dividends. I've also put in job seekers benefit here, just to let you know. Sorry, to the job seekers benefit. So when you lose your employment, you go into you get like 9 months government support. That 9 months, it's based on your PRSI contributions. That's an actual taxable income. After that 9 months, you move on to like a job seekers, and that's not in the taxable. So there is a few exemptions there that are exempt from income tax. So back to work, job seekers, rent a room, and there is one called artist exemption. There is other ones as well. I just wanted to highlight those, and they are supposed to go on your return even though they are exempt. I've just noted down here residency and domicile. This is a new thing that has been introduced into the tax returns there a couple of years ago. And the reason why I wanted to highlight it is because depending on the combination of these factors will be determined on what you actually need to return to Ireland. So an Irish resident is an individual that has spent 183 days in the year in Ireland, or 280 days over a 2-year period. Ordinary residence takes 3 years to gain it, and it takes 3 years to lose it. And then the one then that's domicile, it's not actually defined in legislation at the moment, but broadly speaking, it is where you live, where you intend to be. When you're born, you can automatically get a domicile of origin. You can choose to change that domicile later on by taking the necessary steps. But I just wanted to highlight, so say for example, you're Irish resident and Irish domicile. You're taxable in your worldwide income. So regardless if you had a rental property in the UK or a rental property abroad, you need to return that income onto your tax return. If you have paid tax abroad on that income, you will get a reduction for that. So there is a double taxation treaty available with nearly every country. So you don't have to pay tax twice, but you do need to return it. Say, for example, you're Irish resident, but you're not domiciled. You're only living in Ireland for a couple of years, you're working, then you're only taxed on Irish generated income and income that's remitted to Ireland. So if you did have rental income abroad, you wouldn't actually have to return that to the Irish revenue. So looking at these factors will determine on what you need to tell revenue and what you need to pay tax on. So tax payable, I've just touched on it from a personal point of view. So income tax, PRSI, USC, and prelim tax are the 4 taxes that has to get paid every year. Income tax, if you're a PAYE worker, this will all be returned by your employer. If you're self-employed, you need to return that yourself. And that's what you have to file every year under your tax return. I've just done a wee quick calculation here just to kind of show you how the tax works. So if you're a self-employed individual, you're taxed on your adjusted profit. So in this case, I put in an adjusted profit of 48,800. I just wanted to show that if you made a pension contribution of 6,800 in that year, your taxable profit then becomes 42,000. Therefore, your full tax is taxable under the 20% band, and there's no 40%. So you have saved yourself 6,800 at 40%. Then you have to reduce your tax credits. So that, again, they're dependent on your personal circumstances. And I will go into a bit more detail on those later in the next slide. So as I was saying here, so how this works is everybody's taxed on their personal circumstances, whether you're married, single parent, married 1 income, married 2 income. So for example, if you're a single person, you can earn up to 42,000 at 20% in the year in 2024, and the balance is sitting at 40%. But if you're married or in a civil partnership with 1 income, you're taxed at 51,000 at 20%, and the balance is at 40. But if you're married with 2 incomes and you're jointly assessed, you have 51,000 at 20%, and the 33,000, or you get an additional 33,000 or the lower of the second income at 20%, and then the balance comes to 40. So the important part there to note is that it's 33,000 or the lower of the second income. And then once we've identified our actual tax, what we need to pay, how do we reduce that tax? The main one is tax credits, and these are available to everybody, but again, they are based on your personal circumstances. If you're a single person, if you're a single person with a child, then you have your PAYE and earn tax credit. So the PAYE tax credit applies to people that's employed by an employer. And then the earn tax credit then is if you're self-employed. So if you're completing your tax return, you need to make sure you tick the correct box. You will only get the maximum of the 1,875, but you still need to make sure you tick the correct one. There's a few other ones there. Incapacitated child credit is 3,500, but there is a lot of tax credits that are available, but you need to know which ones they are. I would advise you, if you are speaking to your accountant, or if you want me to look at it, just make sure you tell us what your personal circumstances are, because as long as we know what the situation is, we can advise you what's the best or what's available for you. Other deductions as well. So after you have worked out now, you've done taken your tax credits, what else can you get back from revenue? Revenue will allow you a 20% deduction on your medical expenses. And that includes doctors and consultancy visits, hospital treatments, medication that's prescribed by the doctor, has to be prescribed, so you can't just go into the chemist and get paracetamol or something like that. Non-routine dental. Non-routine is the key there. So if you get a clean or an extraction or a visit, they're deemed routine and they're not allowable deduction, but anything that's not just falls out of those categories, then they would be allowable. Physiotherapy and chiropractor as well is an allowable deduction, but provided you get that prescribed by the doctor. So if you are getting one done, I would advise you to go to the doctor, get a note from them to say that you need this for your own health. Then you can claim then 20% back. But please note that it's 20% back on income tax paid. So if you haven't actually paid any income tax, you won't get the 20% back. In addition to that we do have nursing home fees. And this one is it's a 40%, you get a reduction on your 40% band, which is quite high. So if you're paying for an elderly parent, you can claim this on your tax credits, provided you pay for it yourself. And there's tuition fees as well, you get 20% back on that. So if you're either for yourself or for a family member, for a child, provided you pay the fees, you can claim a reduction from revenue as well on taxes paid. So you may claim income tax at 20% for amounts over €3,000 for full-time courses and 1,500 for part-time courses, up to a maximum in the year of 7,000. So say, for example, your child was in a full-time course and the course cost 5,000. You would claim the 2,000 of a deduction at 20% because it's the 5,000 less the 3,000, because the first 3,000 is exempt. Pension, I think Pascal has covered that in detail earlier on, and he's done a good job at it, but it is an allowable deduction, and it is based on the rate, either 20% or 42%, depending on what tax band you're in. And then there's just one here, the flat rate expenses, and this only applies to PAYE workers. It doesn't apply to self-employed. So Revenue have given a full guidance of what falls into that. So it's to cover like doctors, you have dentists, you have retail workers. There's loads of different industries that Revenue has said, okay, we'll give you a set tax credit to cover, say, cleaning of uniforms, just to cover everyday costs that aren't uncovered through your employment. Just to touch on PRSI, again, this mainly applies to employees or self-employed, sorry. Employees, you'll be paying this through your employer, but if you're self-employed, you will have to pay 4% PRSI, and that's based on the total profits of your business. The minimum €500 or 650 for 24 if you have a taxable profit of over €5,000. And this is the PRSI that is used towards your stamps or towards the pension in the future. So it is worthwhile paying it just to cover that for the future. And then the USC is an additional tax that Revenue have taken in. So once you generate income greater than 13,000, you need to pay USC. And these are based on the rates of, like, the first 12,012 is at 0.5%, the next 13,748 is at 2%. And so Revenue have given different bands. They change slightly every year. But if you earn less than 13,000, you don't have this tax to pay. But if you earn €13,010, the full 13,000 becomes taxable. It's not that it's not for everything over the 13,000, it's the full value. Revenue have introduced a reduced rate of the USC, and this is if you're over 70 years of age or if you have a full medical card. You can claim a reduced USC rate, and that means you don't have the higher rates. You just have the 0.5% on the first 12,000, and then the balance then is at 2%. That only applies for the full medical card, not a GP card, which is important to know. And also it only applies if your income is less than 60,000. So once you go over the 60,000, the full amount becomes taxable. And then the last tax then that has to be paid by the 31st or the 14th of November is prelim tax. And this is literally an advance payment on next year's taxes. And there's a few different ways to calculate it. You have 90% of the tax due for of that tax year. So in this situation, that'll be 90% of the estimated of your 24 tax bill. Or you can pay 100% of the current year tax bill, which is 2023 tax bill, or you can do 105% of the previous year, which is the 22 tax bill. It is very useful to pay the prelim tax. When you think about it, you're filing your tax return now in November, December. So you have 10, 11 months already earned of income. So you're literally just taking the tax on that and putting it aside. For late payments, if you don't pay your prelim tax, revenue could charge you interest, and they will charge it from the 14th of November or the 31st of October 23. So by the time you pay it in 24, you could have a full year of late interest if revenue charged that. So it is worthwhile paying it. This is what, when you log in to complete a Form 11 for self-employed. This is what what the return will look like. If you're a PAYE worker, you will have something very similar, but you will complete yours through a system called My Account, while business customers will do it through ross.ie. The My Account version is a reduced down version. It doesn't have as much detail in it, but if you're self-employed, you need to go through this section. So if you look down the side, you literally start at the top and you work your way through the return. Personal details, self-explanatory, your name, date of birth, married. Self-employed income, this is where you're at. If you're self-employed, where all your income will go. Your Irish rental income, your PAYE, BIK and pensions section here, that is where your employed income will be. If you're employed or your partner will be employed, it will be under here. Under the second section, under the PAYE, BIK, that is where it'll show up if you've received any social welfare payments, say you're on maternity leave or you had sick pay, your state pension, that will all be disclosed within that section and you need to declare it. Also in this section is where you're going to include your pension. So in here, there is a section where you put in your earned income. So you put in your employed income and your self-employed income, and it will calculate how much you can actually pay into your pension, depending on your age. The calculation is completed within this section. If you're a PAYE worker, this is where you'll be putting in your additional pension if you've made an additional contribution. If you're self-employed, you put your additional payment under charges and deductions. So it is slightly different and it can be quite complex. So I would advise you to make sure you're doing this right if you're doing it yourselves, but it is worth seeking advice on this one. The system isn't user-friendly on it, and you need to make sure that you're ticking the right boxes. Your personal tax credits, and here then is just the other key area that I would highlight. You have to make sure that you tick it. Just because you've marked down that you're married or that you're single, revenue might not pick up on the actual tax credit. You'll have to tick that you have earned income, that you have PAYE income. Otherwise, you will lose the credit if it's not ticked. Under the PAYE system, you still need to tick it, but revenue have them pre-populated for you, so you know which ones are there. You just have to select all. So it is slightly different. So that's what the system will look like. You just work your way through it, and by the time it comes to the end, it should be telling you what your tax should be. I would advise you to know roughly what you want your tax, like what you expect it to be, to make sure that you haven't missed any credits or deductions. Just wanted to highlight, seeing as we're talking about pensions today, where they go within the section in your Form 11. So as I said, the two key areas is your PAYE, BIK pensions 2, and then your charges and deductions. So if you look under the PAYE, BIK pensions 2, you have allowable deductions in employment. You have the directorships, your employments, but the one we're looking here is pension contribution relief. And in there is where you're going to put in all your details about your income and how to calculate what you can actually earn tax-free. So I'm just wanted to show, so say for example, you had employment income of 50,000, your self-employed income was 60, so your total income in that year was 110,000. Your age between 44 and 49, it's 25%, I think that's correct. And you can claim a maximum of 27,500. So we know what we want to expect to get tax-free. So then the system here is where it calculates it. So this is a complicated bit that I think people might need a bit more support on, but this is where you have to put in your gross employment income. It'll work out your rate. That's based on the information that you've previously given. And the maximum relief that you can get on that 50,000 is 25% is 12,500. If you have made any contributions through your employment, it also goes in here, or if you've got additional contributions, it will go in here as well. The second section here is for self-employed. So say you had self-employed income of 60,000. Your relevant earnings on that is 60. So then you can get the 25% on that. So it does reduce it based on your PAYE. So the PAYE comes first, and then the section then is your self-employed. But the total of those should be your full maximum allowance. And is there anything else? No, that's it. So I just wanted to highlight where it goes on the return. And it does the calculation for you, but you do need to know where to put it. That's a very high level review of income tax. Just wanted to point out a few key areas just to let you aware of them and what needs to be taxed and what doesn't. But if you have any questions, by all means, you can let me know.
Jennifer, thank you very, very much. Guys, how financial planning works best is when your accountant and your financial advisor work together. And what happens with us a lot of the time at this time of the year is where employee or self-employed accountants actually get in touch with us and they tell us what they're advising their clients to put into their pension contributions. And that way, your financial advisor and your accountant can actually work together to make sure that it's done and done right. And that's the best way to do it, guys. So what we'll do is, Jennifer, we'll have a few questions. So we'll just have a wee look at them. So this comes in from Michael McGinty. Do you say that there is no BAK in employer payments to an employee pension? Hello?
Yeah, talking to me?
Sorry, I'd lost my screen there. Sorry, guys. I don't know what happened. It went blank on me there. I thought I'd lost everybody. So you're back anyway. So Michael, yeah, there are for an employee within a company scheme or in a company PAYE, there is no BAK anymore on PAYE, sorry, on PRSI contributions. That's done away.
Yeah.
AVC, in layman's terms, what exactly does it mean? Additional voluntary contributions. Can anyone invest in any amount of additional voluntary contributions? I think you showed a slide at the start. It depends on your age. Additional voluntary contributions are based on, well, first thing you got to work out, well, listen, what are you actually paying first? Then you go to the age of the person that you actually are, and you can bring it up to the maximum. So if you're based on your age, if you're allowed 30% of your earnings and you're paying 6% through your company scheme as a public servant, then the balance can be put into an AVC. So it's additional voluntary contributions. If you're in company schemes, Michael brings up a very good point. You're not allowed to go and do a personal scheme. It has to be an additional voluntary contribution. So you can't have, well, revenue don't want you to have a private pension if you're already in pensionable employment. Pauline, can I get a copy of the recorded, please, as I missed the start of the session? Absolutely not, Pauline. If you're not there to start, we're not giving, no, absolutely not. Of course you can, I'm only joking. It will be available to you. Of course, we will make it available to everybody that wants it. It will be up on our YouTube channel as well. Michael, is this superannuation scheme only a thing for civil servants? Yes. Civil servants or public servants are in superannuation schemes. Doctors, teachers, nurses, superannuations, it's an older model of a pension scheme. The likes of, say, the American companies, and we all know who they are in Donegal, they don't have a superannuation scheme. They have a defined contribution pension scheme, which is slightly different. AVC still apply, but it's not a superannuation scheme, public sector only. Do you have a podcast or a blog? Yes, we do. If you go onto our website and have a look, there is a link that takes you to our YouTube channel. We also have a newsletter. So if anybody wants ongoing advice from us, by all means, let us know. We'll put you on the YouTube channel. Sean Logue, is it better to pay extra AVC into company schemes 40% or make an extra payment to my mortgage to reduce the interest paid? Okay, Sean. Yeah, good question. And it really depends on the who and the what of it all. And what I mean by that is, one, depends on your age. Second, it depends what interest rate you're on your mortgage. Now, if your mortgage is sitting with certain lenders, if you're unfortunate enough to be with them and your interest rate sitting at 7%, then we probably need to look at that. If you're 62 years of age and you're coming to retirement and you're wondering whether you should pay down your pension or pay into your pension or pay down your mortgage, I would probably tell you pay into your pension. So it really, really depends on who you are, what age you are, and ultimately, what is the overall goal? So to look at one piece of financial plan in isolation to everything else, it can be difficult to give good, solid advice on it. So we would be recommending a holistic approach. And what I mean by that is that we look at what you're actually trying to achieve. What is the overall goal? And then we can make informed decisions, and we can help you make an informed decision as to whether you should pay down your mortgage or whether you should pay into your pension. But it's a great question, Sean. Is there a recording of this available? Again, recording? No. Why would we do this? Absolutely. I'm joking. Of course there is. Yes, absolutely. So Sean, age 45, 4% mortgage interest. Sean, again, 20 years left in the mortgage. Sean, I need to know a lot more, to be honest. I need to know a lot more about you as to whether I would tell you to pay down your mortgage or not. I don't know. And that's the truth. And if anybody tells you one answer without knowing more about you, it's not going to be great advice. I would need to sit down with you and have a good chat, walk through what your financial goals are, what else is happening in your life. Have you got kids going through college? You know, what age are the children? Are you paying down other loans? All of that sort of stuff. So there's a lot more going on than just answering that question. But the fact that you got extra money, look at doing something with it. So guys, we've spent a good bit of time. We're heading nearly to the hour. As I said before, the best way to get the right financial advice, one, engage with an accountant. Even if you're a PAYE worker, it is hugely important to talk to somebody that can actually help you. Guys, we all know that tax evasion is wrong. We all know this. But tax avoidance is not. And the best people to talk about tax avoidance are accountants. Jennifer is a great accountant. She's worked with a few of our clients. She's hopefully going to be working with a lot more of them as we go. Sit down with your accountant, guys. If you're looking for pension advice, if you're looking for income protection advice, if you want to actually look at that pension life cover, how to get tax relief on that, I'm your man for that. Anything else to do with pensions, anything else to do with tax relief, Jennifer's the woman. Guys, use her. She's there. We've taken
questions, I'm here.
We've taken advantage of her, and we're going to continue to take advantage of her for our customers. If you're not a customer, why not? Get to be, guys, and you'll also get access to Jennifer. So I'm here to answer questions. So is Jennifer, guys. As always, give us a shout if you have any questions. And thanks for joining us. Hope you enjoyed it. And tune in for our next one. Take care. Bye-bye.
Thanks, everybody.